Most investors spend their entire lives asking one question: when should I buy? They study charts, follow market trends, and wait for the perfect moment to strike. But very few ever master the other half of the equation: when should I sell? Benjamin Graham, the father of value investing, believed that learning how to sell wisely was just as important as knowing what to buy. Yet, it's the part of investing most people ignore until it's too late. Selling well requires discipline, patience, and above all, emotional control. Because when markets rise and your portfolio is glowing with gains, it feels unnatural, even painful, to part with a winning position. We tell ourselves it can go higher. We want to believe the good times will last forever. But Graham understood that profits aren't real until they're protected. In his view, the true test of an investor's intelligence is not how he behaves when buying, but how he behaves when it's time to sell. He once said that the purpose of the intelligent investor is not to make brilliant predictions, but to avoid stupid mistakes. And nowhere is that more true than when greed whispers just a little more. Graham's approach to selling wasn't emotional, it was logical. He believed that every purchase must come with a plan, including an exit strategy. He didn't rely on hunches or feelings, he relied on value, the relationship between what something is truly worth and what the market is willing to pay for it. But he didn't always have this clarity. Like every great investor, Graham's rules for selling were born from painful experience. Before he became the voice of discipline and reason, he was a witness and a participant in one of the most dramatic manias in financial history. It was the late 1920s. The air was thick with optimism, and Wall Street had become a casino of confidence. Stocks only went up, or so people thought. Even the most rational minds were caught in the euphoria, and Benjamin Graham was no exception. He would soon learn that the hardest time to sell is when everyone around you insists there's no reason to. And when the inevitable crash came, it would change the way he thought about selling and protecting gains for the rest of his life. Because sometimes the best investment decision isn't the one that makes you money, it's the one that prevents you from losing it. But before Graham became the cautious, disciplined investor history remembers, he was about to face a lesson that would shake his confidence and reshape his philosophy forever. The year was 1929. Wall Street was roaring with a confidence that bordered on madness. The ticker tape couldn't keep up with the buying frenzy. Taxi drivers, barbers, and office clerks were suddenly market experts, offering stock tips with the same certainty as seasoned brokers. Benjamin Graham was already a respected money manager by then, running his own firm and managing capital for clients who trusted him completely. He had built his reputation on careful analysis, on buying undervalued companies with solid fundamentals. But even he began to feel the pressure of a market that refused to acknowledge limits. He saw stocks double, then triple in a matter of months. Companies with little earnings and less substance were priced as if the future could only bring perfection. Every warning sign, high valuations, easy credit, speculative mania was dismissed as the new era of prosperity. Graham, like many others, tried to remain cautious, but the market kept rising and his clients grew impatient. How could someone so intelligent be missing out on the easy profits everyone else was making?
So he did what most investors eventually do when reason is drowned by the roar of the crowd. He compromised. He held on longer than he should have. He delayed selling what had already given him fair returns, convincing himself that prices still had room to rise. And then the world changed. The autumn of 1929 brought silence to the trading floors. Prices that had seemed unstoppable began to crumble, slowly at first, then all at once. Within months, years of gains were wiped out. Companies that were once symbols of prosperity vanished into bankruptcy. Graham watched as his portfolio and those of his clients fell sharply. He had not been reckless, but he had hesitated. The lesson was brutal but unforgettable. A profit unprotected is no profit at all. That experience scarred a generation of investors, but it also shaped Graham's greatest insight about selling. He realized that it wasn't enough to identify value when buying. One must also recognize when that value has been fully realized. He wrote years later that the intelligent investor must always distinguish between paper profits and real gains. Markets can give you temporary wealth, but they can take it away just as quickly. The 1929 crash taught him that markets move not in straight lines, but in cycles of human emotion: optimism, euphoria, panic, and despair. And to survive those cycles, one must have rules that are stronger than feelings. That was when Graham began forming what would become one of his core principles: you must sell based on reason, not emotion. In his later writings, he warned that the most dangerous 4 words in investing are, "This time it's different," because it never is. That simple truth remains just as relevant today. Think back to the dot-com bubble or the tech frenzy of 2021. The names change, the excitement feels new, but the psychology is the same. Investors hold on because they believe they're witnessing a new era. They forget that every era eventually ends. And when it does, only those who learn to sell wisely, calmly, rationally, and early enough keep what they've earned. But for Graham, the crash of 1929 was only the beginning of his education. It wasn't enough to know why to sell. He needed a reliable way to decide when. And that led him to refine one of the most important tools in investing: the concept of intrinsic value. In the years following the crash, Graham became obsessed with one question: how could intelligent investors know when to sell? If market prices could swing so wildly from euphoria to despair, there had to be a rational anchor, something unchanging beneath all the noise. That anchor, he concluded, was intrinsic value, the true worth of a business based on its assets, earnings, and prospects, not the market's temporary enthusiasm. To Graham, the stock market was like a voting machine in the short run, driven by popularity, headlines, and emotion, but like a weighing machine in the long run, where true value eventually revealed itself. This understanding transformed how he approached both buying and selling. He no longer viewed selling as timing the market. He saw it as a matter of discipline. Once a stock's price had risen well beyond its calculated intrinsic value, the intelligent investor's job was simple: begin to sell regardless of what the crowd believed. During the early 1930s, as markets began a fragile recovery from the depths of the Great Depression, Graham quietly sold positions that had rebounded sharply. Many criticized him for being too conservative, for leaving money on the table. But he wasn't chasing tops, he was preserving gains. And time proved him right. Many of those recovered stocks later fell again, as economic instability continued. Graham had protected his capital, while others, driven by hope, watched their newfound profits vanish.
He often wrote that an investor should never confuse price with value. The market can assign any price it wants to a stock, but that doesn't change what the company is truly worth. When the price stretches too far above value, risk increases, even if it feels like success. This idea remains one of Graham's most misunderstood lessons. Selling when everyone else is optimistic feels wrong. It feels like you're walking away from opportunity. Yet Graham reminded his readers that the intelligent investor must act on facts, not feelings. Consider the modern parallel. In 2021, tech stocks soared to astonishing valuations. Businesses trading at hundreds of times earnings were praised as unstoppable. Many investors ignored fundamentals,
believing innovation alone justified any price. Then the correction came, swiftly, brutally, and those who failed to sell learned the same painful lesson investors learned in 1929. The higher the price climbs above intrinsic value, the greater the risk of loss. Graham's disciplined approach gave investors a framework for decision-making. He would later codify it into a set of simple, timeless rules. Sell when a stock no longer offers a margin of safety. Rebalance when gains distort your portfolio. And never let excitement override evidence. This focus on intrinsic value gave him clarity in a world of confusion. It removed the need for prediction. He didn't have to guess what the market would do, only whether the price made sense. But Graham also knew that discipline alone wasn't enough. Markets could stay irrational longer than expected, and investors could easily second-guess their own analysis. So he began developing something deeper, a set of rules to protect investors from their own impulses. Because as he would come to learn, intelligence in investing isn't about knowing what will happen next, it's about having a plan for when it does. And Graham's plan for selling would become one of the most practical, timeless parts of his entire philosophy. By the mid-1930s, Graham had distilled his lessons into a few clear rules for selling, principles that continue to guide disciplined investors to this day. These weren't theories born from hindsight. They were battle-tested truths, forged in the fire of real market crashes and recoveries. The first rule was simple, yet profound. Sell when your valuation target is reached, not when the crowd agrees with you. For Graham, the decision to sell should always be tied to a rational estimate of intrinsic value. When a stock's price climbs to or beyond that range, the margin of safety, that protective buffer between price and value, disappears. Holding beyond that point means you're no longer investing, you're speculating. He often warned, the investor's worst enemy is likely to be himself. Greed, after all, has no upper limit. Once a position turns profitable, the temptation is to hold for just a little more. Graham knew that this emotional trap destroys more wealth than any market crash ever could. His second rule was equally timeless. Rebalance when success throws your portfolio out of balance. Imagine, for example, an investor in Graham's era who held a diversified basket of industrial companies, utilities, and railroads. After a few good years, one or two of those holdings might double or triple in price, suddenly making up a much larger share of the portfolio. To the average investor, this might feel like progress, but to Graham, it was danger disguised as success. He advised trimming those oversized winners, not because he believed they would fall, but because he believed in balance. Selling some of what had gone up allowed him to lock in profits and redeploy capital into undervalued areas.
In modern terms, this principle still applies. Think of the investor who held Apple, Tesla, or Nvidia through massive bull runs. A disciplined Graham-style investor might have sold portions along the way, not out of pessimism, but prudence. By doing so, they reduce risk while maintaining exposure to opportunity. The third rule Graham taught was one of temperament. Never make sell decisions based on fear or excitement. During every bull market, investors feel invincible. During every bear market, they feel doomed. Graham called these Mr. Market's moods, the daily emotional swings of the collective investing crowd. To him, the intelligent investor's job was to observe Mr. Market, not imitate him. He urged investors to think of themselves not as participants in the market's madness, but as independent business owners evaluating real companies. If the price offered by Mr. Market was unreasonably high, sell to him. If it was irrationally low, buy from him. But never let his mood dictate your actions. This calm detachment became one of Graham's greatest strengths. When others panicked, he stayed rational. When others got greedy, he stayed grounded.
He also introduced a practical rule many still follow: set predetermined sell criteria before buying. Before purchasing a stock, Graham would ask, under what conditions would I sell this investment? He wrote those conditions down. Then, when emotions ran high later, he could rely on logic rather than impulse. It's a principle that transcends time. Whether you're buying railroad stocks in the 1930s or tech companies in the 2020s, the smartest time to plan your exit is before you even enter the trade. But perhaps Graham's most counterintuitive rule of all was this: sometimes the best sale is no sale at all. He recognized that great businesses bought at fair prices could compound value for decades. Constant trading often hurt more than it helped. So while he advocated disciplined selling, he also taught patience, the art of letting time do the heavy lifting. In his later years, he refined this balance. The goal wasn't to sell often, but to sell wisely, guided by reason, not reaction. And yet, even with these rules in place, Graham faced one of the greatest challenges of his career, a test that would reveal how even the most disciplined investor could be humbled by the market itself. Because the real test of any philosophy isn't in theory, it's in the moment when the market turns against you and your convictions are all you have left. In the late 1940s, after decades of surviving and thriving through crashes, panics, and recoveries, Graham faced an ironic dilemma, the kind every disciplined investor eventually encounters. His rules had protected him from ruin, but now they risked keeping him from extraordinary gains. By this time, the U.S. economy was recovering from the Great Depression in World War II. Industries were expanding, innovation was accelerating, and optimism was returning to Wall Street. Graham had built his reputation and his fortune on careful analysis and defensive investing. But as stock prices began to rise again, some of his most undervalued holdings started to surge far beyond his original estimates of intrinsic value. According to his own discipline, he should have sold, and often he did. But in some cases, those companies continued to grow dramatically for years afterwards. His students, including a young Warren Buffett, noticed this. Buffett once remarked that Graham's strict focus on valuation sometimes caused him to miss out on truly exceptional businesses, the kind that could compound for decades. This moment in Graham's career revealed something profound. Even wisdom has its limits. His philosophy was built for protection first and profit second. It wasn't designed to chase runaway growth.
And yet, this flaw was also his genius, because Graham understood that missing a big win hurts far less than suffering a catastrophic loss. His approach wasn't about perfection, it was about survival and consistency. He believed that no investor, no matter how skilled, could predict how high a stock might go. But every investor could protect themselves from losing what they'd already earned. In other words, the goal was not to sell at the top, it was to sell before the fall. One story from his later years illustrates this perfectly. Graham had purchased shares in a utility company that, by his calculations, was deeply undervalued. As the market recovered, the stock tripled in price. True to his principles, he sold when it hit his target. But in the years that followed, the company expanded further, and the stock doubled again. When asked if he regretted selling too soon, Graham smiled and said something that summed up his philosophy. "Regret is for those who speculate. I am satisfied with sound profit." It was a reminder that wise investing isn't about maximizing every opportunity. It's about minimizing unnecessary risk. And in that spirit, Graham refined his approach once again. He began to distinguish between two kinds of selling, one for protection and one for portfolio discipline.
Selling for protection meant reducing exposure when valuations no longer offered a margin of safety, when optimism had pushed prices into dangerous territory. Selling for discipline, on the other hand, meant making measured adjustments to maintain balance and rational allocation. The key was intention. Every sale had to have a reason that could be explained in one sentence, and because the price is rising was never one of them. Still, the lesson of the late 1940s humbled even Graham. It reminded him, and us, that investing is a conversation between logic and emotion, between reason and regret. No system is perfect, but a sound philosophy can save you from your worst instincts. And in the decades that followed, as Graham's students carried his teachings into the modern era, this lesson would evolve, merging his discipline with a new understanding of quality and growth. But before we get to that, it's worth exploring how Graham's ideas about selling and protecting gains anticipated the psychological traps that dominate markets even today. Graham understood something that most investors still struggle with today, that the hardest part of selling isn't math, it's emotion. He often said that the investor's worst enemy is not the market, but himself. Fear and greed, those twin forces of human nature, make selling one of the most psychologically demanding actions in finance. When prices rise, greed whispers, "Hold on a little longer, you might miss the next rally." When prices fall, fear pleads, "Don't sell now, it'll recover soon." And caught between those voices, many investors do nothing, or worse, they act at exactly the wrong time. Graham saw this play out countless times during his career. In the roaring 1920s, people refused to sell because they believed the boom would never end. Then, in the crash of 1929, they refused to sell again, this time because they couldn't bear to lock in losses. The result was devastating. Wealth that could have been preserved vanished entirely. He realized that selling wisely required something stronger than intelligence. It required temperament, the ability to detach from the crowd, to view your portfolio not as a reflection of your ego, but as a collection of facts and probabilities. In The Intelligent Investor, Graham described the stock market as a moody partner named Mr. Market, one who shows up every day offering to buy or sell your holdings at different prices. Some days he's euphoric, other days despondent. The intelligent investor's job, Graham said, is not to mirror his emotions, but to take advantage of them.
When Mr. Market is overly enthusiastic, bidding prices to absurd heights, that's when you sell. When he's depressed and selling quality assets at bargain prices, that's when you buy. This simple metaphor was revolutionary because it turned emotion into strategy. Instead of fearing volatility, Graham taught investors to use it. And yet, he knew that most would fail to do so. Why? Because selling feels like admitting uncertainty. When investors hold a winning stock, they start identifying with it. Selling feels like letting go of success, like closing a chapter they're proud of. That's why Graham advised writing down, before buying, the exact reasons you would sell. It could be a valuation threshold, a change in fundamentals, or an overconcentration in one position. This pre-commitment removed emotion from the equation when the moment arrived. In today's markets, this principle is more relevant than ever. With instant access to data, social media hype, and a constant stream of market commentary, investors are bombarded by noise that amplifies both greed and fear. Graham's wisdom offers an antidote. Think independently, act deliberately, and measure success not by how often you win, but by how rarely you lose big. Selling, in his view, was not an act of defeat. It was a declaration of discipline. the mark of an investor who understood that preservation of capital is the foundation of compounding wealth. Still, Graham's journey with the psychology of markets didn't end there, because as he grew older, he began to see that the greatest strength of the intelligent investor wasn't just rationality, it was patience. And that realization would shape his final evolution of his philosophy, one that ties together his lessons on buying, holding, and selling into a single, timeless rule. In his later years, after teaching generations of investors and refining his philosophy through decades of booms and busts, Graham arrived at a profound conclusion. He realized that selling wisely wasn't about prediction at all. It was about preparation. The best investors, he wrote, don't decide when to sell in the heat of the moment. They decide long before emotion enters the picture. This idea became one of his final and most powerful contributions to investment thought. The intelligent investor sells according to rules, not reactions. For Graham, those rules were simple but demanding. First, he advised that every investment should be purchased with an exit plan already in place, a target value based on fundamentals, not market sentiment. If the stock reached or exceeded that value, the investor should begin selling gradually, locking in gains and reducing risk. Second, he taught that no single stock should ever dominate one's portfolio. Rebalancing wasn't just about diversification, it was about humility. Selling partial positions after large gains prevented overconfidence from clouding judgment. Third, and perhaps most importantly, he emphasized periodic portfolio review, a ritual of reflection where the investor examined each holding with cold logic. Would I buy this stock today at its current price? He asked his students to consider. If the honest answer was no, then it was time to sell. This framework liberated investors from the tyranny of emotion. It turned selling, the most feared and uncertain act in markets, into something methodical and almost serene. Graham himself practiced this discipline throughout his career. By the time he retired from active management in the 1950s, his record spoke for itself. He had not only restored the fortune he lost in 1929, but multiplied it many times over, not through speculation, but through patience, prudence, and principle. And he did so while shaping a generation of investors who would carry his philosophy forward, none more famous than Warren Buffett. Buffett would later describe Graham's approach to selling as rationality in a world gone mad. Even though Buffett evolved beyond Graham's strict definitions of value, he never abandoned the spirit behind them. The idea that the investor's greatest weapon is not brilliance, but behavior. The modern markets, with their algorithms, trading apps, and lightning-fast news, may seem far removed from Graham's world of ticker tape and ledgers. Yet his warning remains as sharp as ever. Without rules, every investor eventually becomes a victim of their own success. So what, then, is the essence of Graham's wisdom on selling? It's this: protect your gains the same way you protect your capital. Never let profit turn into pride, or discipline into delay. Because, as Graham taught, the intelligent investor is never afraid to sell when the reasons for holding no longer exist. The stock market will always tempt you to believe that this time is different, that the rules no longer apply. But the truth, the timeless truth, is that the rules of prudence never go out of style. Graham's legacy reminds us that success in investing isn't measured by how high we climb in a bull market, but by how well we endure the bear. And selling wisely, with patience, discipline, and humility, is what ensures that when the storm comes, we not only survive it, but stand ready to prosper again. Because, in the end, as Graham would say, the market may be unpredictable, but human nature never changes.